And they always have been willing to adjust the pace at which they're tapering the taper should they need to. And this was very much expected. This is along the lines with we're going to be patient. We're going to be continuing to watch the data. And should we feel the economy needs additional support via the balance sheet, the Fed is ready to step in. That being said, the press conference is really going to give us some further details as to whether or not the committee is actually thinking about beginning to slow that pace of roll-off in the near term. More likely, this conversation needs a bit more vetting out, and they're not going to commit to any specifics until probably the second half of the year. Now, we did see, if you remember, back in the December FOMC meeting minutes that some committee members talked about slowing that pace of roll-off, but it was really only in the context of as they near that right size of the balance sheet. So I think it's still very preemptive to expect any change or any specifics in terms of adjusting that balance sheet roll-off.
So look at the market reaction. Melissa, Dow's up 380 points now, so we've added about 100 points since the statement was released. You can see they're
gone down a tick.
10 years down, Bill. The dollar index is down by about a quarter of a percent now, so this is a sharp reaction.
I mean, there was something different in this. I mean, this is worth 12 handles on the S&P 500. That's not nothing. Steve, I want to go back to you in terms of the clarification on the balance sheet. I understand that the Fed's not signaling anything different right now in terms of what it does with the balance sheet, but this language of ample reserve seems to indicate that reaching the normal level might be much sooner than the markets had thought. And it's interesting, too, because J.P. Morgan came out with a note just this morning saying that it believes that the level of reserves, that basically the Fed will have to keep more reserves on its balance sheet for a new normal.
So, Melissa, sometimes you know too much. I'm sort of in that situation. The market, as judged by the New York Fed's primary dealer and market participant survey, was already looking for a big balance sheet and already sort of figured out that it was going to be maybe in the $3.5 trillion. The number in the J.P. Morgan report is pretty much spot on with the average in the New York Fed survey. Maybe casual people who have not been following the ins and outs of these surveys had an idea that the Fed had further to go. But we've been saying for a very long time that they've done $500 billion. They may have $500 billion or a little bit more change to go after that. So they are now, however, you're correct in the sense that they're sort of codifying or otherwise making policy this idea of having a large balance sheet. So that's significant in that regard, I'd say.
Yeah, I think this is a very technical issue. If you look at the assets and liabilities, the thing is the assets of the Federal Reserve have come down about $500 billion on track. But if you look at the excess reserves of the banking system, from their peak, they were $2.7 trillion. They're now down to $1.5 trillion. And this has got to do lots of different things. One of them is people are actually carrying more dollar bills and $100 bills around the world. That's part of their liabilities. One is the Treasury Department has got a bigger checking account at the Federal Reserve, and that's squeezing excess reserves too. So when they say reserves may not be sufficient, what people don't realize is the reserves are falling much faster than their assets. That's a very technical point.
But what do they do about that?
Well, they can stop the balance sheet runoff, and there's no problem with that. But the thing I don't like about this statement about the balance sheet is they say they might do that for economic and financial reasons.
This is what's very important, because you're suggesting that people like J.P. Morgan, who came out this morning and said they're not going to shrink it as much anymore, that the technical explanation for that is what you're describing, which has nothing to do with the economy.
Exactly.
But the Fed's not explaining that here.
That's the whole point. That's what Jay Powell has to get across is, look, we're not doing this because we're scared of the economy. We'll do something about interest rates if we're scared about the economy. But the fact is the nature of a balance sheet is changing, and maybe we don't need it to be as small
unless
as we thought.
they do think it's about the economy.
See, Alicia, this is when I think the average investor's eyes are starting to glaze over, because we're spending so much time on the balance sheet. Very important. But how is it important to the average investor out there?
I think it's a signal, and I think it's exactly what David's saying. I mean, there are real consequences on the reserves, but for the average investor, this is a signal about whether the Fed is open to new data or not. And clearly today, what we got was everything that the market was hoping for.